Hello, and welcome to this lecture on the transmission of monetary policy through businesses and households. Our goal in this class is to better understand how changes in the interest rates are passed through to borrowing costs. We will see how this matters for businesses, particularly small and financially constrained firms that do depend on variable rate bank loans. This can have knock-on effects for investments and jobs in the economy. We will then examine how the same channel impacts households. Here we will focus on the housing market and mortgage loans. We will see how changes in interest rates matter for households with the option to refinance their mortgage. And then we will discuss the implications for aggregate demand in the economy. Let's get started. Let's first look at businesses. Almost all firms take out some form of debt. The largest corporations have access to the bond market, which is fixed-rate debt. Smaller firms typically only have access to bank loans. These business loans often have a floating or variable interest rate. This means the loan interest rate is equal to some floating benchmark plus some fixed markup. The floating benchmark could be one of, in the past, the London Interbank Offer Rate or LIBOR, the Secured Overnight Financing Rate or SOFR, or possibly the prime rate, which is the interest rate offered to the best borrowers. In general, this means that the interest rate that the firm pays moves with short-term interest rates. Let's see how this connects to monetary policy with an example. Assume that a firm has a $1 million business loan. Let's assume that the interest rate on this loan is SOFR plus 2%. Like the federal funds rate, SOFR is an overnight interest rate and the two move closely together. So let's assume that the federal funds rate and SOFR are currently 4%. This means the loan interest rate is 6% and total annual interest payments are $60,000. Now let's assume that the FOMC decides to cut the federal funds rate to 1%. The SOFR will follow this downward move. This means that the interest rate on the firm's loan will reset from 6% to 3%, reducing the interest rate payments to $30,000. The reduction in the federal funds rate hence frees up $30,000 that the firm could use for investment and hiring. More generally, a reduction in the federal funds rate will increase the profits of leveraged firms. Another implication of higher profits is that the firm's balance sheets and equity valuation will improve. With higher profits, the firm is in a better financial position. This may further reduce borrowing costs. Does the data support these ideas? Well, yes and no. Research has examined how businesses respond to an increase in the federal funds rate and whether it matters for the economy as a whole. The research indicates that large firms are mostly unaffected when rates increase. They maintain their levels of production and employment when interest costs increase and revenue declines. These larger firms have no problems accessing commercial paper markets and other sources of short-term credit. This allows them to increase their short-term borrowing even when profits decline. At the same time, the inventories of large firms grow. In sharp contrast, the transmission of monetary policy to the borrowing costs of small firms matters a lot more. Smaller, more financially constrained firms respond to an increase in interest rate costs by reducing inventory and by cutting work hours and production. Importantly, for the economy as a whole, the effect is still sizable. This is because smaller firms still employ more than one half of all workers in the United States. Moving on, let's now examine how households respond to monetary policy. That's not to say that all households are carefully reading statements from the FOMC. However, their decision-making will react to prevailing economic conditions, including changing market interest rates. The largest line item on a household's balance sheet is usually their mortgage. This graph shows you the interest rate on a 30-year fixed-rate mortgage and the federal funds rate. As you can see, the two rates move together, so mortgage rates will react to changes in monetary policy. How big of an effect can we expect from mortgage rate changes? The answer depends on how indebted households are. If households have zero debt, then changing borrowing costs will be irrelevant. The map shows you the median debt-to-income ratios for households across all counties in the United States in 2007, right before the 2008 financial crisis. As you can see, many counties have households with debt that is more than 3 times their annual income. With such high borrowing relative to annual income, changes in the interest rate may have sizable effects on household finances. While some mortgages in the United States have an adjustable interest rate, most mortgages are fixed rate. When the FOMC decides to lower the federal funds rate, mortgage rates tend to decrease as well. In response, households may decide to refinance their current mortgage. This means the household replaces their current mortgage with a lower interest rate mortgage. Also, this can involve upfront cost. The interest rate savings due to refinancing can be substantial. Let's go back to the graph with the mortgage interest rate, but focus on the 21st century. In 2006, the mortgage interest rate was about 6.5%. In December 2011, it had fallen below 4%. A household that had not paid any principal could save almost 40% on mortgage interest expenses by refinancing their mortgage. And a lot of people did. Recent research found that the average household that refinanced saved almost $1,000 per month in mortgage payments. What did the households do with the extra cash? Households that saved on mortgage payments tend to consume more. For instance, people may go out for dinner or start renovating their house. Spending on durable goods and cars increases. As a result, the demand for goods and services go up, which benefits businesses and stimulates the economy. Let's wrap up. In this lesson, we were specific about how monetary policy transmits to the economy. When the central bank changes the interest rate, this can impact the interest expenses of businesses and households. We saw that the effects matter most for small, financially constrained businesses. We also saw how a lower policy rate reduces mortgage payments of households. In the aggregate, lower interest payments can stimulate greater consumption and investment. This means the overall demand for goods and services goes up.